Holy smokers, this ain't no dang jokers. Wow, folks. Do we have a lot to go through in this video here today, folks? I mean, my gosh, my number one stock, the number one most important stock to me, number one biggest position in the public account just reported earnings. I want to take you through the numbers. Shocking. Simply shocking numbers. And I'm going to show you exactly what's going on here, okay? We've got other very important stocks that just reported earnings. We're going to talk about some opportunities I see in this market. We're going to talk about some things that are going on right now that are going to shake up your portfolios in a pretty significant way. The Fed made a move today. That wasn't even an important part. There was two super important parts of what Jerome Powell said in his, let's call it question answer session afterward. That was actually extremely important, that a lot of people are kind of glossing over and totally missing, that are so important to the markets going forward and the economy and a lot of various things. Okay, so anyways, appreciate everybody joining me as always. Thanks so much for being subscribed, folks. I appreciate you being here. A lot to go through. I even brought a water, man. You know, when I bring a water, it's a serious, real deal Holyfield video, and we got a lot to go through in this one. If you'd like to apply to join my private group, check out the pinned comment down there. You can fill out an application, and we can see if you're a good fit to join us in there. Alrighty, so Meta. It is the number one biggest stock in the public account, and I'm actually going to make a prediction on where I think Meta stock's going to end this year as far as the stock price goes, okay? So in regards to this quarter, very good quarter, okay? This was not the shocking part. We'll get to the shocking part in a moment, but the quarter was very good. They beat on top line. They beat on bottom line. Revenue came in at about $32 billion. That's versus $28.8 billion the same quarter last year. So basically, revenue's up over $3 billion on a year-over-year basis. We will take that, okay? Research and development was up a little bit. You kind of expect that to be there, right? As far as, research and development up there, cost of revenue up a little bit. Marketing and sales actually went down. General administrative was up substantially. That number was up a little too high for my liking there. Total costs and expenses up, as you can kind of assume, right? I think profitability will definitely improve in the next 2 quarters, although it obviously is already improving. Income from operations was up about $1 billion roughly on a year-over-year basis. Net income was up over $1 billion, about $1.1 billion or so on a year-over-year basis. And obviously EPS was up quite substantially. If you're going to look at a diluted basis, which is what most folks look at, 298 versus 246 in the same quarter last year, right? So clear as day, Meta's on the right track, okay? But the next slide is much, in my opinion, even more important, okay? This is huge. Look at this. This shows you advertising revenue by geography for the quarter. And what you're going to find is every single market is growing for them, regardless of where it is. U.S. and Canada up, about what we call about $1.3 billion year over year, right? Europe was up. This is pretty shocking because Europe is kind of seen as, one of the weaker economies right now because they've even gotten hit by inflation even harder than the States has, right? And I mean, we're talking about revenue that was up nearly $1 billion on a year-over-year basis. That's shocking, right? Asia Pacific, very nice growth there, and then rest of world growth as well, right? From about $3.1 billion to $3.6 billion. So every single geography you want to look at is growing for Meta substantially. Now, the more important thing, in my opinion, and the more important thing for the stock price, is we have a company that went from basically a company that was not just decelerating growth, but was actually starting to go down in the U.S. and Canada in terms of revenue to now increasing, right? So if you look at Q2 2021, $13.3 billion of revenue. Last year in the same quarter, they went down to $12.7 billion. Now they just re-accelerated growth and got back on the right track, and now they just did $14.1 billion of revenue in the U.S. and Canada. That's massive for the stock, okay? Absolutely massive. This is one of the things that freaked a lot of people out. It was the crazy spending that Meta was doing, and then compounded with U.S. and Canada revenues that were going down on a year-over-year basis, right? That was shocking to folks. Well, those days are long gone, and we're now back to very nice growth. Now, net income-wise, right, which is the holy grail for a company like Meta, a more established company like this, right? We broke a huge trend, and things are going our way now massively, okay? So if you look at Q4 2021, right, basically after that time, net income just kept going down and down and down, quarter after quarter after quarter, until it finally bottomed in Q3 2022, right? And then since that time period, we've started to increase net income quarter after quarter after quarter, right? Several quarters in a row now at this point in time with kind of an explosion up here in Q2 versus Q1. But the best part is, I think Q3 is going to be probably the second best quarter in the company's history, second or third best quarter in the company's history. And there's no doubt in my mind, based upon the shocking revenue guidance this company put out, that Q4 is going to be the best net income quarter in the history of the company. And I think it's going to be by quite a substantial margin too. And so we're going to be talking about a Meta that's reaching all-time records in terms of revenues and net income, which is obviously extremely important. The company's still spending. They're still spending a lot. CapEx, right? But the spending's under control now, right? If you look at year to date, what they spent in 2022 at this point in time versus 2023, it's roughly in line. The spending's under control and Wall Street loves that, right? I love that even personally. Family daily active people is still growing, 2.88 billion in this same quarter last year, 3.07 billion in this most recent quarter. Family monthly active people, and by the way, if you're confused, if you don't like own the stock, you don't track Meta, you're like, what the heck's family daily active people? That just means somebody using one of their apps on a daily basis, whether it's Facebook, Instagram, WhatsApp, Facebook Messenger, like something like that, right? It could even be, Threads moving forward. So family monthly active people, 3.65 billion in the same quarter last year, 3.88 billion. I mean, at some point in time, I think every single person in the world is going to use at least one of their properties on a daily basis. It's incredible, right? Now, this is extremely, extremely important, okay? Extremely important. So what you're looking at here is average revenue per user, ARPU, which is seen as one of the most important metrics to judge a company such as Meta. And it's kind of seen as like any social media related companies. You kind of got to judge them by that, okay? And so back when Twitter was public, they used to judge them by ARPU, Snapchat, any of the other competitors, if we want to call them that, okay? So now what's interesting here is check out the ARPU in US and Canada, right? $53.53 average revenue per user. That's versus $50.25 this same quarter last year, right? Europe was up quite substantially from 1564 to 1788. As far as Asia Pacific, 454 to 488, and then the rest of the world's up to 376, which I believe is an all-time record now for rest of world versus 335 in the same quarter last year. But the important thing to remember with this is there's a long way to go. ARPUs in the US and Canada still have quite a ways to go, but remember, look at this as kind of like, let's call it a goalpost, right? Now, does Europe ever get to $53.53? I don't know, maybe not. But I can tell you Europe's going to be at a place where their average revenue per user is going to be substantially higher than $17 in a few years from now, okay? Asia Pacific is eventually going to get to $10 plus, and the rest of the world will get to $10 plus average revenue per user. So just keep in mind the numbers you're seeing today are very low compared to the numbers you're going to be seeing from this company in 3 years from now, 5 years from now, 7 years from now. And that's why Meta long-term will be $1,000+ stock. Just one of many reasons, because you're going to see this ARPU just continue to go up year after year after year for a long time to go into the future, right? Now, balance sheet-wise, right, this is very exciting. So this is just in a 6-month period. This looks at December 31st, 2022 versus obviously this most recent quarter. And the cash and cash equivalents has doubled for the company. They went from $14.6 billion to $28.7 cash and cash equivalents. That's in a 6-month span. They doubled their cash balance. That's incredibly impressive. Total stockholder equity has gone up almost $10 billion in the past 6 months, right? $125 billion stockholder equity at the end of 2022. And now, halfway through the year, we're sitting at $134 billion of stockholder equity. That's extremely impressive. Now, something I think is very important to remember here in the Meta story is if you're going to speak negative about Meta, people say, oh, Zuckerberg, he's still spending so much on the Metaverse, man. So much on the Metaverse. And they're taking these massive losses. It's true, they're taking massive losses on the Metaverse still, right? But it's very important. Quest 3 is going to hit this fall at some point. Does it hit October, November? We'll see. My guess is, especially with the hype around what Apple's done for the space, right? And the fact that you can't get Apple's product anytime soon, and that's going to be unrealistic price points, the Quest 3 should put up some pretty insane numbers. Now, once they get actually to selling these products, right, and then people sign up for the monthly plans that I think are $8 a month or something like that, the losses are going to start cutting down. And then they're going to cut down in a pretty substantial way starting in Q4, but really you're going to see that reflected in 2024 in general. So a lot of people think like, they're just going to have these losses forever, and they're kind of modeling in a lot of that, when I see like 2023 is kind of peak loss year, in my opinion, in regards to like the Metaverse whole situation. And I think in 24 moving forward, you're going to see actually much improved profitability there. That does not mean they're going to make profits on this, let's call it, area yet, okay? But nonetheless, you're going to see those losses cut down in 2024 and moving in future years, okay? Now, this is shocking, okay? Simply shocking what just took place here. So the CFO Outlook commentary, this was so important, okay? They said, we expect third quarter 2023 total revenue to be in the range of $32 to $34.5 billion. Our guidance assumes a foreign currency tailwind of approximately 3% to year-over-year total revenue growth in the third quarter based on current exchange rates. So basically the midpoint of this, because you always want to, if a company gives a range like that, you always want to look at the midpoint. So the midpoint here is $33.25 billion. Now, why does that matter so much? Okay, I'll show you exactly why that matters. Remember that number, $33.25 billion. Analysts had this company, on average, growing to $31.1 billion for next quarter. So keep in mind, even the worst numbers, $32 billion is substantially higher than what analysts were expecting, almost $1 billion. But remember, their midpoint's 33.25. So which means they're expecting to get this business back to 20%-ish type growth when analysts were at 12%. Now, 12% is fine, but when we start talking about 20% growth, oh my gosh, folks, okay? We're no longer talking about Meta as just a value opportunity. Suddenly, we are now talking about Meta as a growth stock again. Now, that fundamentally changes the way you have to value Meta stock. Right now, Meta is valued as a value stock. You look at its forward PE, you're going to see a forward P of, let's call it 20, 22, something like that. Now, keep in mind with that revenue guide, that likely means the company's going to be far more profitable in the back half of this year and in 2024 than anybody had anticipated. Which also means if you're seeing a forward PE that says, let's say 22, actually lower than that right now. But you add on top of that the fact that now we're getting this back to being a growth stock, if they're going to start growing revenues 20%-ish type numbers, and you have to start valuing it as a growth stock, which means you've got to start putting forward Ps of 30s and 40s in front of the stock. Which means the stock price has to go up substantially more, which is very intriguing. And this is why Meta is just the most well-positioned stock in kind of big tech land, because there's a lot of big tech stocks that just aren't positioned that well. But Meta is actually positioned even after this insane move from $88 a share back in Q4 of 2022 to where it is now at 300 plus, and it has a long way to go, okay? Now, if you want to look on the competition front, they're eating their competition's lunch. You look at what Google McDougal, which Google's always, in my opinion, the best comp for Meta, if you're going to comp Meta against anybody. And the numbers are just better at Meta. They just are. You look at basically what Google McDougal's doing for kind of like growth rates, and then you look at what Meta's doing for growth rates and what they're expected to do for growth rates, and it looks like Meta's eating Google's lunch right now. Does it really matter? No, but it's great to see a company execute like that, right? Because, remember, Wall Street has a limited amount of money. Everybody has a limited amount of money to put in the market, right? So some people are going to consider, do I want to buy Google for the next year, or do I want to buy Meta for the next year? Because we know Wall Street thinks very short term. At the end of the day, Meta's still the stock to buy, even though it's way outperformed Google already, right? Now, I had over $500,000 right into these earnings, right? Where do I think Meta stock's going to end this year, in my personal opinion? Okay, I'm a very happy shareholder. And as far as where I think this stock is going to end the year, in my personal opinion, outside of some major market crash or something like that, if we just have a decent market, I believe the stock is going to end, and it might shock some people. I believe the stock will be $400 to $500 a share at the end of this year, outside of a market crash or something crazy like that, right? That's where I think it's ending. Even if the NASDAQ was to say flat the rest of this year, flat, not even go up, just flat, I think it still ends $400 to $500 a share. When I look at a company that now we're talking about is getting back into growth category numbers, and the valuation's still far too cheap, I mean, my gosh, the sky's the limit here with Meta. So this is just a perfect scenario. I mean, absolutely perfect scenario. I couldn't ask for more. I couldn't ask for more from the Meta team. I am a very, very happy shareholder, and I have no plans to sell the stock anytime soon. The stock could run to 400. It could run to 500. It could run to 600, and you won't see me selling, because at the end of the day, like, man, it's just the valuation is still too darn attractive, even at these, even if we're talking about these sorts of prices. I mean, you slap a $400 price on this stock, it's still probably only trading at a forward P of 20. Based upon what I think they're going to earn in 2024, and they're going to grow revenues 20%-ish? I mean, come on, man. Like that's just a steal. It's still stealing money, even here. Okay. Now, we're going to get back into earnings. We're going to get into some other things that are shaking up the market, some things I'm looking for. But let's take a little intermission here. Okay. Two super important things happen in that Fed meeting today that I think a lot of people are missing. Okay. And this is going to obviously change a lot about the economy, about the markets moving forward, and things like that. Okay. So Jerome Powell, I watched the whole, press conference and whatnot, and I thought this was one of two super important things. He says, I'm saying we would be comfortable cutting rates when we're comfortable cutting rates. And that won't be this year. I don't think it would be, okay? So basically, it looks like Jerome Powell is taking off the table the possibility or potential at all of cutting rates this year, okay? Now, you could see that one of two ways. The first way you could see that as is this is scary, because what if the economy starts to weaken and things like that, and he's not going to cut rates? You could see it that way. The second way you could see this is if this man is confident and the Fed's confident in saying we're not cutting rates this year, then they're probably pretty darn confident that the economy is going to hold up at least this year, right? We could talk about next year and the year after and those sorts of things, but at least for the rest of this year, he's very confident. I don't think that's a crazy assumption, considering we only have 5 months roughly left in the year, and considering how low unemployment is, right? I mean, even if unemployment started to tick up, it's still going to be historically ridiculously low, right? So from that standpoint, I can kind of understand him taking that viewpoint. Now, they obviously raised interest rates today. I don't agree with that personally. If I was running the Fed, I would be either stagnating interest rates or I would be considering cutting. Okay, that's me personally. I don't run the Fed. That's their job. But I think the longer you obviously keep rates in an elevated place, especially when the economy is not used to it, the more likely those Fed lags will eventually catch up, right? And so that is something we have to take into account, that eventually that can happen, okay? But the second thing was even more important, in my personal opinion, about what happened here today when it came to the Federal Reserve, okay? And you saw the market jumping around huge. Here's what happened. Fed Chair Powell said the central bank could raise rates again or hold them steady in September depending upon new economic data. He says, I would say it's certainly possible that we will raise rates again at the September meeting if data warrant it. And I would also say it's possible that we would choose to hold steady. And we're going to be making careful assessments. I said meeting by meeting. And he talks about, when he was talking in the press conference about we get 2 more CPI reports, we get 2 more jobs reports to kind of make our decisions based upon that. So he's, once again, not even talking about cutting. The only reason that cutting even came in is because somebody asked him a question specifically about that, so we had to address it. So the Fed, we know for basically the rest of this year, they're only considering raising or they're only considering staying steady, right? Which, once again, in my personal opinion, it's the wrong decision to make. They should be either considering steady or cutting, my personal opinion. So that's where the Fed's at, right? And the worry is the Fed goes too far, too long, right? We know the economy is a big giant that once it gets moving one direction, up or down, is a hard baby to flip back the other way, and it takes months and many times years to get that baby back, going in the right direction. So that's a big worry from my standpoint, is that they keep rates too high for too long. The economy starts to weaken. They don't react fast enough, right? And next thing you know, all of a sudden things start to get bad in 2024 and they're all of a sudden freaking out, cutting rates. But by that point in time, it's too late. The dominoes are falling the wrong way and you can't kind of turn the thing around fast enough. And next thing you know, you got a mess to clean up. And next thing you know, the money printer's going again, right? Which ends you back up in the same bad scenario you didn't want to be in the first place. So that's kind of my thoughts on the whole situation. We'll see what happens. And also, you don't know what the Fed's telling the truth about versus what they're, you can say fibbing about or lying about and those sorts of things. So we'll see how it all shakes out. But that's what's going on there. The bottom line is, for everybody that's watching this at home, always remember, the longer the Fed keeps rates at an elevated place, the more risk it has to the economy, okay? And I can't not mention this. The one good thing I will say about rates being at an elevated place right now is if you've got money in treasuries, if you've got money in savings accounts, you're making really good returns for the first time in like 15, 20 years. You're able to get 4 or 5% on your money, which is sweet. So I will say that's the one good thing that is awesome, is for the people that have money, like they're really being helped out by the situation. Unfortunately, you know who's not? People that don't have money, right? Because they don't have the sort of money around to get that 4 to 5% on treasuries and savings accounts and things like that. But if they want to go buy something like a new car, they're having to pay these insane interest rates, right? So that's where you get into some real pickles. And that's where we're in an economy right now that it's actually a pretty good economy. If you're somebody that makes good money, let's say you're a 6-figure earner, make over $100,000 a year, like this is kind of perfect for you. If you got money, you're loving this. But if you're somebody that's in a poor financial situation, like a lot of these things aren't benefiting you as much as you might hope, right? Chipotle. So Chipotle down huge after hours. Down $188 a share after hours. Down 9%. I came so close to buying put options on Chipotle that expire on Friday. I was literally about to put in the order, and I was like, that's just a stupid gamble, Jeremy. Like, what are you thinking? Like, this gambling Jeremy talking. I always have this bad guy on my shoulder who's like, hey, puts on Chipotle. And I'm like, dude, no, okay. He was right, but at the end of the day, I'm still glad I didn't do it because that would have just been a straight gambling move. But, so what happened with Chipotle? Is it a complete disaster? Well, why don't we dive into the numbers and see, is this a complete disaster? Woo! Revenue increased 13.6%. Comp store sales increased 7.4%. Anybody that knows anything about comp store sales or comp restaurant sales, that's ridiculous, okay? That's amazingly ridiculous. In-restaurant sales increased 14.8%, while digital sales represented 38% of food and beverage. Operating margin 17.2%, that's an increase from 15.3%. Restaurant level operating margin 27.5%, an increase of 230 basis points. Diluted EPS of $12.32, a 33% increase versus the previous year. What? Opened 47 new restaurants with 40 locations, including a Chipotle? I don't have to look into that. Okay, the numbers are flipping amazing. Okay, there's no way you can look at these numbers and be like, this is bad. No, these numbers are amazing. They're about as good as it gets for a company like Chipotle, to be honest. Okay, but there's a huge problem. Why don't you see me out there buying Chipotle stock this year? Okay, I'll tell you exactly why. There's a huge problem here with Chipotle, and it has nothing to do with their revenue or comp store sales or profitability or any of that. This is the issue with Chipotle, the valuation of Chipotle. At the end of the day, we know, Chipotle's built out, obviously, an immense amount of restaurants over this past 15 years or so, right? So in terms of new locations, I don't want to say they're maxing out, but, because they can always put more Chipotles out there, but I'm just saying, like, the big growth days on a percentage basis of Chipotle are behind it rather than in front of it, right? Just natural numbers. But the company has this ridiculous valuation on it. It trades at this year numbers, based upon what they're supposed to earn this year, 46 PE. Based upon next year, almost a 39. I mean, those numbers are incredibly high. And you're talking about, these are the sort of valuations that you would expect from like a high-tech growth stock. Like, I don't know, a Tesla. Remember, Chipotle's got much higher valuation metrics than Meta. Chipotle trades at about double what Meta does, roughly, in terms of forward PE for 2024. That's pretty extreme, right? And so the reason I'm not buying a stock like Chipotle, and I'll show you the stock I'm buying that I think is a much, much better play risk-reward, is I just look at this company and say, great company, great numbers, but the stock trades so rich that it's basically stolen so many gains from the future. And so you're setting yourself up for, if the company comes in with any troubling numbers over the next couple years, let's say margins go down, let's say revenue goes down for whatever reason, whatever, you're setting yourself up for potential big downside in the stock. And when I say big downside, I'm talking 40 to 60% downside, okay? On the flip side, how hard is it to get a company like Chipotle to double over the next few years? Very difficult because of the valuation it's already trading at. It's very difficult when you already got that sort of forward P on you to then, talk about the next level of growth. So for a stock like Chipotle, the risk reward at this point in time is just not super attractive. A few years ago, it was a different situation. Back when they were dealing with all the health problems that they had in some of their restaurants back in kind of like, what year was that? That was like 2015, 2016. That was a really attractive time for Chipotle. I mean, the stock was trading at $200, $300, $400 a share at that time. If you want to step in then, that was a very interesting time to be stepping in Chipotle. At 2,000 plus, or anywhere near those numbers, it's just the risk reward is not good. So where I find a much better risk reward, in my opinion, in this market right now is Cake. Cake is expected to have stronger EPS growth on average over the next 2 years than Chipotle, right? But the difference is I'm paying super undervalued prices with Cake, right? We're talking about 13 times this year's projected numbers and 11 times next year's projected numbers with Cake, right? With still strong, location growth, especially because of North Italia and many of the other concepts they have. So when I look at something like Cake, I say the risk reward is so much more attractive. The chances I double my money on Cake over the next few years is much higher than Chipotle. And the chances I lose 40 to 60% of my money over the next few years is much lower than something like a Chipotle at the end of the day. So that's why at the end of the day, when I look at, kind of the restaurant category, I'm going to go with something like a Cake over a CMG. And if I wasn't to go with that, I would go with, Texas Roadhouse, kind of next up there, right? Now, one of the most attractive stocks, in my personal opinion, for the short term is this company named Mattel, right? No, so they just came out with earnings after the bell. The stocks are not really moving up or down, but the current numbers don't even matter for this company, what they just reported. They just had a complete fundamental change in their business model that's going to change the business model for future years and kind of moving forward now at this point in time with how huge the Barbie movie is, obviously, right? And that's a potential. It looks like Barbie movie could do $1 billion plus in sales worldwide. It looks like it could do between $500 million and $700 million domestically. And those numbers might end up being conservative. We'll see how it all shakes out. So we're looking at just a huge smashing success for the company, right? And that's going to make massive licensing agreements that the company's going to be able to do and make tons of licensing revenue off of, obviously, the Barbie brand being reinvigorated. And at the end of the day, Barbie sales are going to go through the roof. And so this is going to be a very interesting dynamic. And remember, around every October, November, going into December, everybody on CNBC and everybody starts talking about like what are the big toys this year, right? What are the big toys? And everybody's going to be talking about Barbie this year, right? Halloween, everybody's Halloween costumes are going to be Barbie and Ken. Everybody's going to be talking about Barbie dolls are like the number one, obviously toy this year and those sorts of things. And so the Barbie business is going to get an absolutely epic boost, but it's not just a short-term boost. When you come out with a movie this huge, it's a multi-year boost for your company. Plus, people are going to start looking at future movies and products that they have that are going to, shake things up in this industry as well. So when I look at this company, it's in a really, really good position for at least the next several years. But I will say I'll listen to their conference call and see what's going on there. But don't be surprised if the numbers coming in over the next few quarters are more on the shocking side, especially when it comes to not just revenue, but really when it comes to EPS. Because when you have this sort of demand that they're going to have coming in, you don't have to watch price. You don't have to watch price. And if you just have something that's maybe a few dollars higher than what you would usually sell it for a business model like this, it means so much to the bottom line. It's ridiculous and what it means to your margins overall. So Mattel is in a really good position. I can't wait to listen to the earnings call tonight, or I'll try to listen to it tomorrow morning. We'll see what happens, but I'm really, really excited for that one. Now, people have been asking me recently about Fubo, right? Like this stock is so bipolar. It's crazy. The moves you see for Fubo is ridiculous. The market doesn't even have to move much, and you see Fubo going up or down 5-10% a day. It's ridiculous. It's like the ultimate, I guess you can say, day trader stock. Like literally, like the moves are parabolic with this stock on a daily basis. It's insane. It's like almost every day I pull up the different stocks I own, and like Fubo is usually the biggest percentage like up or down on a given day. It's ridiculous. Ultimately, the stock's gone up almost 50% this year, roughly, right? It's been a pretty good year for Fubo, although it's been a very volatile year. But things are about to get a whole lot more volatile with Fubo, okay? Here's what's going on. So earnings are coming for Fubo on August 4th. Okay, so obviously that's going to matter significantly to see what their subscriber numbers are looking at and to see if they're continuing to make progress on the profitability side, which is huge for this company. They've been making good progress. Investors want to see this company continue to make progress. But the biggest thing's about to come here, okay? And that is basically when you get into football season, every year Fubo sees a massive spike up in interest and a massive spike up in new subscribers signing up for Fubo. And it adds a whole new like level of customer base around them, right? And the reason being is Fubo's the number one service. Like if you're a college football fan or if you're an NFL fan, it's the number one service you got to be signed up for, okay? And so what we've seen continuously is every single fall, we see a new record when it comes to Google Trends data. Okay, including last year, we saw new records. So what we need to see this year is more new records from August to December, new Google Trends records as we've seen, bigger and bigger bumps over time, right? And so it's going to be a very exciting time because, like I said, every single fall time you see a massive interest in Fubo spike up. And what's been amazing with Fubo is they've been able to keep those subscribers past football season. So it's not like people just sign up for Fubo from, the end of August, because at the end of August, basically, what you have is you have some NFL preseason games that some people want to see, but you have college football start. The very end of August, usually it's like the last week of August, you start having some college football games. And so people start saying, how am I going to watch all these games? Oh, this Fubo seems like the best option for that, right? And so people sign up for that. And then that continues through all the way through basically December. So it should be really intriguing to see kind of what happens here. And they've been doing a great job of just keeping their subscribers around and keeping them interested. And we'll see where the numbers shake out. But don't expect that stock to not be volatile anytime soon. It's just one of those stocks that moves huge on a daily basis. Now, there's three companies that I'm looking the most forward to. I still got a lot of my companies. I probably have at least 10 to 15 of my personal stocks to report this earnings season. We're still very early in the earnings season. But the three stocks I'm looking the most forward to are these three stocks, okay? The first one is Amazon. I believe they're reporting next week, if I recall. And I'm looking super forward to Amazon. I want to hear what's going on with the e-commerce business. Are they improving profitability there? That's going to be super important. And AWS. Everybody's paying attention to AWS growth rates and what's going on there, okay? At the end of the day, if you want to know what's going to move the stock price of Amazon, it will be AWS, because that's always what moves the stock price. People on Wall Street very disrespect the e-commerce business, and so as an investor, I'm looking super forward to it. I hope the stock goes down in the short term because, once again, this is a stock I'm buying all the way to the end of the year. So my hope is the stock goes down. I'm just not that confident of that. Let's put it that way, okay? Now, next stock I'm looking super forward to is Palantir. So Palantir, this is a put up or shut up type quarter for Palantir. We'll call it that, okay? It is a put up or shut up type quarter for Palantir. So Karp and the team, they've been talking a lot, and especially Karp himself, Alex Karp. He's been talking a lot about, hey, we're going to see, incredible demand for our AI products and those sorts of things. The company's got to put up the numbers, folks. And not only do we have to see the numbers, but we got to see the sort of guidance for this company that is, kind of gives us confidence that this is not just talk. What they're putting together with their products and what they're hearing from, companies that want to use their products, this can't just be talk. We got to start seeing it in the numbers. We got to start seeing it in the guidance, and we've got to hear Karp. I think it would be great if Karp could comment at all about what he's expecting long-term growth rates to be, because a lot of us are in the dark in terms of that. It used to be, a couple of years ago, 30% a year. Since that time, and they took that away, now we're a little confused. Is it 15%, 20%, 25%? Can we get back to 30% plus a year? So if Karp can make a comment on that, it's huge. But we can't just have a mundane quarter and a mundane guidance and expect the stock to perform well after the move it's had. A lot of people are expecting this is put up or shut up. And believe me, if they put up the numbers, the stock's going on its next beast run. But we've got to see the numbers. We've got to hear the guidance. We've got to hear that this company is going to continue to perform. And, their AI product's not just talk, and it's like going to put up big numbers, okay? The third stock I'm looking super forward to that is going to be reporting here very soon is PayPal, right? PayPal is another one of those stocks that I'm buying for the remainder of this year. In PayPal, it could even be buying in 2024 as well. I don't think this is one I'm stopping buying anytime soon. So when it comes to PayPal, I'm really looking forward to kind of hearing their numbers. PayPal scares me though. If there's one stock I'm really scared it's going to pop like 10 to 20% on earnings, it's this one. I hope they don't. Obviously, as a buyer at PayPal, I want to buy as many shares as possible for as cheap as possible, but I'm very paranoid that this one's going to spike huge on earnings. I just hope it doesn't happen. So we'll see kind of what happens there. I appreciate everybody joining me as always. Thanks so much, folks. Thanks for being subscribed. If you're looking to apply to join my private group and learn everything I've learned over the past 15 years, download it from my brain to your brain and be able to join us, all the members, 6 and 7 figure club, all those sorts of things, and check out pinned comment, fill out an application. We'll see if you're a good fit to join there. Much love and have a great day.